Welcome again to part 2. We are looking at candlestick patterns, and this is the second part of the candlestick patterns series, where we are looking basically at the different types of bodies that candles have. In the previous video, we looked at the brief history of candlestick patterns, the anatomy of candlestick patterns, bullish and bearish candlestick patterns, and a basic introduction to candlestick anatomy. So we're going to continue again in this series. So long versus short. Long bodies refer to strong buying or selling pressure if there is a candlestick in which the close is above the open with a long body. This indicates that buyers are stronger and they are taking control of the market during this period of time. So basically the size of the candle indicates the volume of buying or selling pressure. The longer the candle, the bigger the volume. And the shorter the candle, then the less power that the buyers or sellers have. So candlesticks with long tails, the upper and the lower shadows give us an important information about the trading sessions. So if you've got a longer tail, or a longer shadow, or a longer wick, then it implies that there is rejection in the market and price consolidated in the areas that are that the body has. In other words, Japanese candlesticks with short shadows indicate that most of the trading action was confirmed near the open and the closing price. So in this particular case, if you have got a longer upper shadow, this signifies that most of the trading happened on the lower part of the candle. If you've got a longer lower shadow, if you've got a longer wick, then price on average was on the upper part of that particular session. So that's essentially what it means. So candlestick patterns are one of the most powerful trading concepts. They are simple, easy to identify, and very profitable when it comes to setups. Research has confirmed that candlestick patterns have a high predictive power and can produce a positive outcome. So that's the value that understanding candlestick patterns has. You can really improve your margins through concise knowledge of your candlesticks. If you know how to read candlestick patterns the right way, you will be able to understand these patterns, what these candlestick patterns tell you about the market dynamics and the trader's behavior, in other words, the trader's psychology. You could see exactly where price is playing, and again, this will help you better enter and exit the market at the right point in time. You know when to enter and when not to enter, also when to exit and when not to exit in your trades. Okay, so we can now start off by looking at a specific candlestick pattern, and we're going to start by looking at the engulfing bear candle. The engulfing bear candle, as it states is in its title, is formed when it fully engulfs the previous candle. The engulfing bar can engulf more than one previous candle, but to be considered an engulfing bar, at least one candle must be fully consumed. So I think those are the conditions for the the engulfing candle. Basically, you have to engulf one or more previous candles in a series. The bearish engulfing one is the most important candlestick patterns. The candlestick patterns consist of two bodies. The first body is smaller than the second one. In other words, the second body engulfs the previous one, as shown here. So you've got the second body being engulfed by the second body engulfing the first body. And in most cases there could be gaps here. So as you can see, the opening price was here, the closing price for this bullish candle was here, but the opening price was actually higher, signifying that there was a gap here. And then of course there's the lower part there. So that's engulfing that candle. So this is an engulfing, a bearish engulfing bar. In case of a bearish engulfing bar, the pattern tells us what the sellers are that sellers are in control of the market. When this pattern occurs at the end of the uptrend, this indicates that the buyers are engulfing by sellers, which signals a reversal trend. So if this occurs at the end of an uptrend, in other words, the maximum point of an uptrend is shown below. So you've got your uptrend there, and then you have your engulfing bearish candle engulfing the previous candle there. Then this is a strong signal for a reversal pattern. So when price action patterns occurs in an uptrend, we can anticipate a trend reversal because buyers are not willing to control, are not still in control of the market, and sellers are trying to push the market to the downside. You can trade any, you can't trade any bearish candlestick pattern. Yes, that's true, because there's need for confluence. It doesn't necessarily mean that each and every engulfing pattern indicates a trend reversal pattern. So it has to be in conjunction with other indicators or other checkpoints in your trading plan or strategy. So there's an example of a bullish engulfing bar. Again, in this case, price was falling, and then we have gotten this engulfing bullish bar, and then we anticipate price to go up. So the bullish engulfing bar pattern tells us that the market is no longer under control of sellers, and buyers will take control of the market. When a bullish engulfing candle forms in the context of an uptrend, it indicates continuation signal. I wouldn't take that last part, that's why I didn't highlight it, but I would take the first part, which talks of who is in control usually. So in a bullish engulfing bar candle forms in the context of an uptrend, a bullish engulfing bar in the context of an uptrend, it signals a continuation. I think it's almost similar to what we had here. So you have got again something like this happening. So of course one can term this in engulfing, but usually it's usually in the when we're anticipating a reversal. Of course, yes, to some extent, depending on how big this is, at times it ends up creating what is called a fair value gap. But these things are sort of closely related. Okay, so there's an example of a bullish engulfing candle engulfing a previous bearish trend and a bearish candle there, and then price continues to move to the downside. And then of course there present is a fair value gap that has been created from here to there. So I think that's another trading concept which can be appreciated. Okay, so in the example above, it shows us clearly how the market changes direction after the formation of a bullish engulfing bar pattern. The smaller body that represents the selling power was covered by the second body that represents the buying power. Okay, moving on. So a doji candle. What is a doji candle? The doji candle pattern, this is one of the most important Japanese candlestick pattern. Truly it is. This candle, when this candlestick forms. So what is it? Basically, it tells us that the market opens and closes at the same price, which means that there's an equality and indecision between buyers and sellers. There is no one in control of the market, as seen below. So for a doji candle, for a pure doji candle, there isn't a body, but there's just a line, and usually it's midway between the top wick and the bottom wick, or the top shadow and the bottom shadow, and then again it indicates indecision. Of course, if it happens at certain price points, for example, if it happens at a reversal point, then it does indicate that the market is indeed is ended. But in this case, it's signaling that buyers are now weak at this point, and there was an indecision there, and then now the market can start to go down. So the formation of a doji candle indicates that buyers are unable to keep price higher and sellers push price back to the opening price. So if you are already in a buy position, then it might be time to take profits. If you are seeing subsequent doji candles coming in, it indicates that exhaustion on the current trend, whether if it was an uptrend, then the uptrend is now exhausted. If it was a downtrend, then the downtrend is now exhausted, and you might consider calling it a day or closing your particular position. The dragonfly doji. The dragonfly doji is a bullish candlestick pattern in which is formed when the opening high and close are the same or above the same price. What characterizes the doji is the dragonfly doji is the long lower tail that shows the resistance of buyers and their attempts to push price up. Okay, so it's a bullish candlestick. That indicates that price is going towards the upside, and it's called a dragonfly doji. So again, it's a subcategory of the doji. So the opening and the closing now, they are no longer at the midpoint, but they are at the very, very top of the wick. So this indicates that buy side control is now present within the market. Okay, so how do we use the dragonfly doji? In the chart above, the market was testing the previous support level. So there was a support right here that caused a strong rejection from this area. The formation of the dragonfly doji with the long lower tail shows us that there is a high buying pressure in the area. So usually this can actually indicate a reversal. When it occurs in a downtrend, it is interpreted as a bullish reversals. Okay. This brings an end to part 2. See you again on part 3, candlesticks patterns. Remember to share, like, and subscribe. Thank you, and goodbye.